Welcome to my channel. I'm Mike, and this channel is about my journey from $10,000 of my own money to $80,000 in 3 years. In today's video, we'll talk about the Greeks. No, not those Greeks. And technically they are Spartans. No, not those Greeks either. We'll talk about options variables called Greeks because they are based on Greek letters. We have delta, gamma, theta, and vega. Vega is not technically from the Greek alphabet. The Greek alphabet does not have a V as we know it. They do have a V sound, but that is represented by a different letter. We call it beta, but it is pronounced vita. Sorry, I got distracted by the Greeks. Let's get back to our business. We'll discuss delta, gamma, theta, and vega. Later in this video, we'll discuss about how bad I'm doing on my positions in this market environment and what stocks I'm watching for next week. The Greeks tell you how an options contract premium can change based on its variable. We have delta and gamma for price changes in the underlying asset, theta for the time decay of the contract, and vega for the volatility change. These don't tell you how an option is priced, but how the price will change in the future. Delta, in my opinion, is the most important Greek. Delta is between 0 and 1 for the call contracts and -1 and 0 for the put contracts. It tells you how much the premium will change for $1 move in the underlying asset. If delta is, let's say, 0.5, that means for a $1 move in the stock price, our premium will move with $0.5 per share. Also, delta is used to approximate the probability of a contract expiring in the money. In our case, our 0.5 delta means there is a 50% chance that the contract expires in the money. If you hedge your positions and strive to have a delta neutral portfolio, delta tells you the numbers of shares to sell when you buy one call contract. So if you have one long call contract with delta at 0.5, that means you need to sell 50 shares of the underlying asset in order to hedge your portfolio to become delta neutral. Personally, I use this calculation to compare buying a call contract versus buying shares, or buying a put contract versus shorting shares. So, for example, if I pay $2 on a call contract that has 0.5 delta, I will compare that with the purchase of 50 shares of the underlying asset. I prepared an example on Palantir's option chain to better understand my examples. We have two option chains on Palantir, one for the 19th of March and another one for the 16th of April. In the middle of the chain, you can see the strike price. To the right, we have the put contracts, and to the left, the call contract. The area in blue is called in the money, while the black area is called out of the money. The closest strike price to the current price of the stock is called at the money. Palantir was trading at $23.95 on Friday at close. If you look at the money call option for the 19th of March, that would be the $24 strike. Our delta is 0.55. That means if on Monday Palantir is trading at $24.95 instead of $23.95, the premium will change from $186 to $244 per contract, all else being equal. In general, a $1 move up for the underlying asset means that delta is added to the premium, and the $1 move down subtracts that delta. If you look at the puts, delta is negative. That means the premium will fall when the stock moves up and increase the other way around. Also, looking at the same contract, it means that we have approximately a 55% chance that by the 19th of March, Palantir will trade above $24. If you have not decided whether you want to buy shares or calls, you can compare how cash intensive each one is. One call contract for 13 days at $24 strike costs you $186, while 55 shares cost you $1,300. If the stock moves $1 by Monday, the call will bring you a $55 profit, and so will the shares, but the profits differ. Also, if Palantir drops $1, you will lose 30% on the call and 4% on the shares. It's your choice what risk you choose and what risk to reward ratio you are comfortable with. If you look at the April option chain, you can see that delta is higher. The longer the expiration date, the higher the delta for out of the money and at the money contracts will be. For in the money contracts is the other way around. Delta decreases the further in time you go. Now that we figured out how delta works, how does delta move? Well, we have gamma for that. Gamma dictates the move of delta for each $1 move in the underlying asset. You can actually see on the chain that the difference between the $23 and $24 delta is 0.09, exactly the gamma value in the table. Theta is bipolar. It can be a friend or a foe. For the option buyers, theta is the foe. It decreases the premium of your contract each day with a certain amount. The closer you get to the expiration, the higher theta will be. If you look at Palantir's option chain for the $24 call contract, in April we have a minus 0.04 theta, while in March, which is closer, theta is minus 0.06. That means for the March contract, each passing day, the premium will decrease $6. On the other hand, we have the option sellers, where I find myself with my short put strategy. For them, theta is their best friend. If the stock decides to do nothing, the premium of the contract will still decrease each day due to time decay, so you will have to pay less to buy back the contract. Vega is the symbol for volatility. It represents the change in premium for each 1% move in implied volatility. This is very hard to calculate in advance, since you don't know what the volatility will be in the future. Implied volatility changes based on news, earnings report, global market sentiment, or even weather forecast. What you know for sure is that after earnings, volatility drops. How much? You don't know exactly. If you look at Palantir's chart, I marked the two earnings reports they had since IPO. You can see the instant drop in volatility after earnings regardless of the move. These are the main 4 Greeks you should look at when trading options. There would be though a notable mention here. There is a 5th Greek, Rho. For option traders, this is not important because it represents the change in options premium for each 1% move in interest rates. Now, interest rates don't move that much that often, but you might want to take a look at Rho if you are trading long-term options like a 2-year or 3-year span. Now, let's get back to our option chain and accurately try to calculate Palantir's $24 strike price for Monday on the 19th of March. Let's presume Palantir will open at $24.95 on Monday. How would the premium look like? Well, first we add our 0.55 delta to the premium. Then we subtract theta for the 2 weekend days. If volatility will remain the same, our contract should be worth somewhere around $2.29 per share. But if volatility falls 10%, then our contract premium will decrease with $20. Let's do a similar exercise on the put side. I'll give you a moment to calculate what happens to the $24 put if Palantir opens on Monday at $24.95 and volatility decreases 10%. You can take the ask as the reference price for the buy. Write in the comment section the results you got. I'll wait.
A few minutes later.
That would be $1.17 per share. That's a 40% drop in price. What should you remember out of all this? Option prices are governed by 3 major variables. The price of the stock, found in delta and gamma, the volatility, represented by Vega, and the time decay, disguised as theta. We know the price, we know the time, but we don't know what happens to the volatility. Although I consider delta to be the most important Greek, volatility is the most important parameter for the premium calculation. As a general rule of thumb, in high volatility periods, you shouldn't buy call contracts because a volatility collapse will crush your premium, although the stock might go in your direction. As I was telling you in my strategy video, I like to sell put contracts at delta around minus 0.3. If you haven't seen the video, you can check it out here. When I buy calls, I usually don't look at Greeks. I buy call contracts more for speculation, so I'm looking for low risk environments. Thus my main indicator is volatility, not Vega, not Theta, nor Delta. If volatility is low, I buy a call contract for which I am comfortable of losing the whole premium I paid, and I expect a swift move in the stock price and a possible volatility increase. I usually don't close my long call contracts if they don't become profitable. I let them expire. This is why, in the future, you might see me trade long option contracts for around $50 to $100. That is the amount I'm comfortable of losing. I do have my exceptions, but that is another topic. If you have any questions on what we discussed here today, please leave a comment down below. If you want a certain topic to be discussed in our weekly videos, please let me know. Now, let's get into this week's trades and my watch list for next week. This week, the market continued its downtrend, and I only entered 2 trades on DraftKings with 2 contracts at strike price $60, and I managed to close it 2 days later for a profit of $122. And on RKT, I have 3 contracts at $23 strike. This trade was made based on stock volatility. RKT had amazing earnings, they decided to offer a $1.1 special dividend, and also got in a short squeeze. All these combined led me to get $62 per contract in premium. That is a lot for a stock like RKT. The other 5 trades were rolls of my current positions, because most of them were deep in the red. Rolling the contracts meant keeping the initial premium, but going further away in time. My worst calendar roll was Nano Dimensions. In order to decrease my risk and move my strike price to $10, I had to move the contracts all the way up to August. This way, I still got a credit when I rolled the contract. Side note, when you roll contracts, you should look for a way to always receive premium. Don't roll a contract when you have to pay a debit. The rest of my rolls were made for a small amount of premium received, but a decrease in my risk by moving the strike price down. This week I made $1,500. This brings me to 48% of my target already achieved in barely 2 months of trading.
Nice.
This is both good and bad. It's good, obviously, because I got almost 50% of my target achieved, but it's bad because this is not normal. Based on my initial calculations, my best case scenario meant achieving 30% of the target in 2 months. This is a trap I'm not willing to fall into. I'm not going to base my future calculations on these particular 2 months. Although I overachieved my target due to recent drop in stock prices, most of my short put contracts expire now in April or May. This locks my margin for at least 1 month. Depending on how the markets will move this month, I might get to free up some margin for some future trades. With this in mind, let's look at some stocks I'm watching for next week. First stock off the bat is Lemonade. I've been watching this stock since IPO. Recently, due to the recent drop in growth stocks, Lemonade reached the support level created in July of 2020. I hope I can catch a decent short put contract at $90 if we have a serious rebound in the market. Overall, I'll be cautious this week since I'm overexposed on my margin, and we don't know if the drop is over or not. My second favorite for the week is Palantir. Again, although the stock dropped below my $25 support area, it seems to be consolidating here. I find this stock to have a much greater potential than Wall Street gives it. If Palantir goes above $26, I look to adjust my current positions and maybe enter new ones. NIO has been hit hard with recent market sentiment. They had their earnings on the 1st of March and there was nothing concerning about them. Besides the EV hype we had until recently, I believe NIO can be an excellent candidate for my short put trades. I'll be looking to sell puts at the $35 to $40 area if I manage to free up some margin. Dropbox is the last stock on this watch list. It performed incredibly well during the last 2 weeks, keeping the $22 support level intact. Unfortunately, it lacks volatility in order to take advantage of high premium. I might take a riskier trade during the next weeks, looking to set my put strike $1 below the price. Let me know in the comment section below what stocks are you watching for this week. What do you think of the current market correction? Will it continue or will it be saved by the stimulus bill? Please hit the like button if you enjoyed this video. You can subscribe and hit the notification bell if you want to find out when I post new videos. Thank you for watching and have a great trading week.